Welcome everyone to Stable Dash for Bluechip edition, recorded at the Bluechip Conference 2025 here in Vienna. I'm Chiara Munaretto, and if you're new here, this show is all about stablecoins. Today, we're exploring stablecoins and the architecture of trust, from macro theory to market ratings. And I'm joined here by Garett Jones, co-founder and chief economist at Bluechip. Thank you very much for being here.
Thanks for having me, Chiara.
Well, let's jump straight right in. I know you've been spending a lot of years and very much of your career studying economics, how institutions and incentives shape economies. And I would be curious to hear more, how do you see the contrast between traditional economists and the crypto scene approaching stablecoins? Traditional economists may approach it more from a shadow dollar perspective, while crypto enthusiasts more as an infrastructure and a must payment. So, to my questions here, how should we really understand stablecoins? Is it a new form of private money, a payment innovation, or really an extension of the current ecosystem?
It's really all of the above. Stablecoins have turned out to be a form of private money that work quite well, and they operate according to sort of an old rule, which is 100% reserve-backed currencies. Almost all stablecoins in the world work that way. They're backed by a fiat. They can be redeemed one for one. And that's something that economists have always known is possible. We've seen this happen in the past, and now through the blockchain, it's happening again. The payments innovation element is incredibly innovative and powerful for the future, I think. When we see that credit card companies are interested in using stablecoins to make 24/7 clearance possible, when we see that people are talking about how to use smart contracts to engage in transactions that couldn't have been done before, to make recalled reversible transactions easier than before. This is an important form of payments innovation. You use the term about whether stablecoins are a form of shadow dollar. For some people in countries where it's hard to get access to stable currency locally, a shadow dollar is better than what they can get locally. That's why there's so many things to study when we look at stablecoins. It is many things to many different clients and to many different markets.
Yeah, and probably also to this concept of shadow dollar comes down maybe to what you were discussing this morning in terms of the need for AML and KYC. So if you don't know where the coin itself is moving after the main person has done the KYC itself, then of course this raises questions from institutions that they cannot track money in the way they should have been able to. Can you elaborate on that?
Yes, definitely. When stablecoins are issued by all the major providers, the person creating the coin has to do some form of a KYC, knowing your customer, revealing who you are. But then once that coin is created, it can typically be exchanged on multiple blockchains, and those transactions can be with completely anonymous people. And some of those are people that modern governments would not approve of being in transactions with, right? And so that is something that places some limits from the point of view of some governments on how desirable is it to have stablecoins be widely globally usable. This is something that the world has come to terms with when it comes to currency, but for that very reason, rich country governments tend to keep the denominations of their cash fairly small. I mean, the euro there used to be a 500 note, and it doesn't exist anymore, presumably because it just made money laundering and tax evasion just too easy. The United States only issues 100 as its biggest bill. Coins on the blockchain can make transactions of millions or even billions effortless, anonymously. The world has to figure out whether blockchain analytics are a good enough tool to keep track of that. Governments have to decide what level of misuse of currency, or electronic or otherwise, they're comfortable with.
Yeah, so indeed, one side we have who uses stablecoins, and then on the other side we have what type of stablecoins are we allowing. So of course we can simply diversify between traditional stablecoins and yield-bearing stablecoins, but in both cases, I would be curious to learn more about Bluechip itself. Of course, you're a rating agency, so you understand very well how to classify stablecoins. So how do you approach it? What are the elements that you take into account when evaluating a stablecoin?
Well, Bluechip is focused exclusively on the economic safety of assets. Our focus at the beginning has been on stablecoins. We're extending that to other assets in the near future, but we're looking at it from the point of view of a person who wants to use the coin. We're not judging it for governments, we're judging it for people. So we want to make sure that this is a coin that we would recommend to our grandmothers, something that is safe enough to use and preferably easy enough to use for folks who aren't incredibly technically sophisticated. And so we rate coins from A+ to F. There are no A+ at this point. but plenty of Fs, and people can check out our ratings on bluechip.org.
Yeah.
But I'd say the two key features that are important to whether a coin gets a good rating or a weak one is whether they can credibly prove that their coin is backed by assets, at least one for one. And second, whether the team that is involved in the coin is actually a credible team that has reasonable controls in place to make sure that they have the best interest of the coin holders at heart. So it's good assets and good system.
And in this case, you mentioned that there are more F than A's. If you were to design the top stable coin that would get like the max of your rating, how would you approach it? What kind of elements would you have in there?
Well, one key is, of course, first to have your stable coin backed 100% by good assets and be...
Can you define good assets?
Well, a simple one would be people backed by short-term U.S. treasuries, short-term euro-denominated treasuries. There's one coin that we've given a very high rating to that is massively over-collateralized with Ether, on average about 150% over-collateralized. And that can also get an A rating with other features in place. So good assets that are audited so that one knows that those assets aren't being lent out to a third party for 29 out of 30 days a month, something like that. And that's really useful. Also, making sure that your assets are bankruptcy remote so that people who hold your stablecoin know that if things really go bad and the parent company of your stablecoin has financial problems, that they can't come after you for the money. So making sure that your assets come in, that the stablecoin's assets are first in line in the event of bankruptcy, not second or third or fifth in line. Those are two really important elements for getting something like an A rating.
I love the point that you made about like a bankruptcy, because usually, at least like within my knowledge of circle of people, I've always read and understood that stablecoins are very much useful for anything related to payments.
Yes.
Right? For cross-border payments, remittances, and anything that comes around moving money in the fastest way possible globally. But you mentioned the point of bankruptcy, right?
Yes.
So basically, it can serve as a almost like second layer in case of a crisis that can support the crash of the market itself. Can we break this down? How would a scenario in which we have a crisis? What would be the role of stablecoins if the stablecoins themselves are pegged to the dollar or let's say the euro?
Sure. Well, let's think about a major stablecoin provider that's, does a lot of complicated businesses.
Yeah.
And so its assets, it might be a $1 billion stablecoin, to pick a number, and maybe they're backed by a $1 billion stablecoin is backed by quite a little bit over $1 billion in assets. And this is set up, it's legal, everyone knows that these assets are really there. But if the parent company gets into financial trouble because somebody in the company embezzled $500 million, they have to, in the United States law, for example, that organization, the umbrella organization, would have to go to a U.S. bankruptcy judge and say, we can't keep all of our promises. You tell us in which order we keep our remaining promises. And under U.S. law, it's not always clear who comes first. For instance, and this is true in many countries, that, for instance, unpaid wages are almost always at the top of the line. So if the employees haven't been paid for 3 months, they might be able to, in principle, get the stablecoin's assets in order to pay their unpaid wages. It's a very simple example, but it's an illustration that you might think your money comes first, but it's not. The world of banking law has made it very clear that the bank's assets will go first to the people who are depositors, people who work in finance firms, where if a brokerage owns shares and holds them on behalf of customers, that those customers really own them, that those can't be used to pay the electric bill, an unpaid electric bill. So knowing that your assets, your stablecoin assets, are held for the sole benefit of you, the stablecoin holder, is a really important thing. If you're worried about these, rare tail effects, I don't think any particular stablecoin is going to go bankrupt this year, but when we think about banking, when we think about things that we call money, we hold money in part because we're worried about worst case scenarios. And that's a reason to be why we at Bluechip put some weight on bankruptcy remoteness.
Interesting. And then in this case, for example, if you consider algorithmic stablecoins,
yes,
that they would not be related to a parent company?
Yes.
What are your thoughts?
And so an algorithmic stablecoin that has well-audited software can, in principle, and in one case in practice, get a very good rating. Okay. Because then it really is the case that code is law. Yeah. And if a highly over-collateralized, purely algorithmic stablecoin can get an A rating, and the reason why is because we've been persuaded, we've come to the conclusion that in the event of a very bad panic, that say if there's 2.5 ETH per dollar of the stablecoin, 2.5 ETH is probably good enough because it would be a less than a 1 in 1,000 event, a 1 in 1,000 month event that you wouldn't have 100% backing for the coin. These are just illustrative numbers, but just to give you an idea. But if you do want code to be law, you need to have a very credibly collateralized stablecoin.
And have you seen in the market any algorithmic stablecoins that is going in the right direction in really embedding this code is law? Or do you think that we are still far from, both from a technological development perspective, but also from an understanding of how to design the ideal stablecoins when we talk about algorithmic stablecoins?
For algorithmic stablecoins, the real problem is a capital efficiency, right? Because if you need to have 2.5 ETH per $2.5 of ETH for every dollar of coin, it's incredibly expensive. And so the one coin that has a very high rating on Bluechip, which people can look up online at bluechip.org, they'll see that it's still small in market cap, and it is run safely by our estimate, but that's just, most people don't want to park that much capital there. People have tried to find ways to get around this problem, to find a capital efficient, more or less algorithmic stablecoin. By my personal judgment, no coin has gotten there yet. I'm always open to innovation, and that's why we keep doing work at Bluechip. We don't just don't have the AIs rating the coins just yet.
Yeah, it's coming for sure. I know.
It's possible.
When it comes down to yield-bearing stablecoins instead, I think before you were mentioning as well that, of course, there are two paths on stablecoins, whether they will be used for savings or whether they will be used just for payments. And in this case, I was just thinking that when it comes down to the savings side, and of course, banks being more resistant to allowing yield-bearing stablecoins to exist, what if banks themselves would be the yield-bearing stablecoin issuers? Wouldn't that solve the problem of banks being afraid of not being in control anymore?
That's a good point. It at least weakens their concerns. But their problem is a problem that's also come up today, which is that people have mentioned today. And I mentioned only a problem from the point of view of banks, which is that we've all got smartphones in our pockets that could easily serve as that could hold yield-bearing stablecoins that would be issued by somebody perhaps closely related to Apple or closely related to Samsung, and that would be outside of the traditional banking world. And that's the real threat from the point of view of the incumbent banking sector, that even if those banks themselves could offer yield-bearing stablecoins, they know that the generations of people, say 35 and under, are very comfortable handling their financial transactions on a phone, and they don't care whether it's called a bank or not. And so they wouldn't lose all of their custom this month, but over the course of 5-8 years, they see that as a big risk. So incumbent banks in the U.S. Managed to succeed in banning interest payments for stablecoins at this point, at least technically. We'll see how much that happens in practice. But young people have been very willing to try flexible financial arrangements, and incumbent banks know that that's a risk to them.
And so you mentioned Apple, you mentioned Samsung. So in this case, I see that we are moving towards money becoming private and moving away from the public institutions, public management of money. So in this case, perhaps more of a philosophical question, how is capitalism going to evolve in this case if we very much emphasize the private issuance of money?
Well, one question is to what extent these are privately issued monies any more than bank deposits are privately issued monies. So economists have been we've been teaching people for a long time about something called the money multiplier, where every checking account in the world is a form of privately created money. And so we're very used to that. What's happened, though, in most of the rich countries is that banks that have these checking deposits are so heavily government regulated that there's a blurry line between the public and the private sector at that point. Stablecoins are now becoming a form of, they've spent a decade plus now as a form of privately created money with very light government regulation. And now as government regulation starts becoming more important in that field, maybe they too will start looking like government entities just like checking accounts do.
Yeah, because in this case, for example, I know that in the UAE, they are going to release the AED-backed stablecoin. So in this case, it's a national currency issued by the, in a way, the government itself, or like the institutional national bodies themselves. So in this case, how do you see a national currency, stablecoin, compared to a privately issued a stablecoin like Tether or Circle, for example? So the issuing body itself comes from either a private company or from the government itself.
Well, in this case, if a Gulf state issues its own private stablecoin, but they actually intend for it to be used globally, then they're actually facing the market test about as much as any private sector firm would have to. Now, of course, if they're just ring fencing this coin so it can only be used inside the country, that's not very interesting. But if they're issuing a coin they plan to be used all around the world, they're competing just like anyone else, I'd say. And they're facing the same market pressures and the need for some form of quality, quality excellence that's demonstrable to the masses, that they end up feeling like a private coin from the point of view of 95% of humanity.
So I guess we will see a lot of competition around stablecoins over the next years.
They're definitely
from all kinds of institutions and bodies.
It does seem likely that there will be some sort of more heavily government regulated coins that will do well in the US and in the European Union. And then there will be some that choose to stay outside that barrier, like Tether will probably have a very plausibly have a very successful business model working outside of that and not signing up for all that regulation, but still being well understood as something that's been reliable for quite some years. But the idea that there might be a fork in the road here between those that stay close to government regulation and close to government management and oversight, and those that keep an arm's length distance, that sort of bifurcation is common in markets because customers like diversity, and there's not much point in straddling the middle of the road there.
We're almost there. I just have one more curiosity question. So when it comes down to the use cases, right? So let's say we're going to have so many stable coins. So I guess that at a certain point, we will have very specific stable coins for very specific use cases, right? Otherwise, everyone will be competing on the same level, trying to be the best for everyday transactions. When it comes down to the interoperability side, if we're going to have so many stable coins, how do we make sure that we can constantly transact different types of stable coins without having our wallet or our bank account with 100 different stable coins?
That's a great question. It seems very likely that won't be an equilibrium, at least as you describe it. A finance theorist, Gary Gorton, said that what makes money money is when it's a no questions asked asset in QA. And like you said, if there's 100 different stable coins and you're worried about a 1% exchange rate difference, if the blockchain fees or, if there's a 1% spread between these two coins and a 0.5% spread between another two coins, sure, in principle, you might say, well, I'll just have an app for that handles all that. But in practice, probably what happens in the long run is that we all just gravitate toward using a small number of coins. I think the only way out of that for a mature industry is to have something like the US system of massive government oversight that sets the standards so clearly that people do feel like there's no questions asked between the various coins. I suspect that that's where we wind up, because a world of 100 coins where people are trying to keep one for this and one for that will be less exciting and less interesting than just picking one coin. And the only path to 100 coins is if people can feel like it's a no questions asked coin.
And I think that's where I'm still trying to wrap my head around it, because we have many currencies right now, and we can't FX is an issue, moving money globally is an issue, but with stablecoins, we are replicating that in terms of the amount of
Absolutely.
options. So
yes, the 100 coins equilibrium, where they all have small different exchange rate differences, even if it's 1 or 2%, is unlikely to last in the long run.
Okay, well, got to work towards a solution there then. Spending the time with us, for whoever is watching. Thank you very much, Garett, for all your knowledge and all your insights. And if you have not been into Stable Dash yet, make sure to have a look at all the other podcasts, and we'll hear more over the next episodes. Thank you very much.
Thanks, Chiara.